Welcome to the On the Edge podcast with your host, Scott Groves. Hey, what's up, everybody? It's Scott Groves from the On the Edge podcast. I'm here with my good friend, Adam Stock, who lives in Chicago, but we won't hold that against him. We know each other from the Front Row Dads group. Shout out to my friend, John Vroman, who runs Front Row Dads. And I like to describe Adam as the Jewish version of the most interesting man in the world. So he does run 3 different companies, one of which is Next Level Planning Group, the Next Level Planning Group that I am a client of, and then also runs a bookkeeping service, also runs a company called Rising Stock, which coaches individuals on profitability and bookkeeping service. He was a classical violinist for 20 years, or classically trained violinist, played basketball at the collegiate level, if I remember correctly, which was pretty shocking to me because you're not exactly 6'7". A father of 5, wonderful wife, wonderful family, thriving business. And he's got a calendar that will make me envious. And I'm pretty guarded over my calendar, but his calendar is something special. So, what did I miss in the introduction of the most interesting Jewish man I know, Adam Stock?
Well, I don't know how many I don't know how many Jewish men you know, so I don't know if I'm one out of 1,000 or one out of one.
A lot.
But,
I'm from Southern California. We know a lot.
Okay, it felt like a compliment. I have an aspiration that's over here on my wall, and I look at it regularly. And my aspiration is to be the most interested man in the world, rather than the most interesting man in the world. So, that's my aspiration is to be super interested in other people and kind of take any focus off of me, because I've found that doesn't get me nearly where I want to in the world, and it doesn't help me learn and grow. What helps me learn and grow is being off of wherever my ego is and more interested in other people.
So I saw this in real time when we first met a couple years ago at a Front Row Dads event in San Diego. I realized after I left dinner, and we accidentally got paired up to do a dinner of 4 or something. I realized after I left, I didn't know shit about you, because you were so good at asking questions and you let the other kind of 2 domineering personalities at the table just talk all night and ask really good questions. And I remember leaving to go, ironically, on the pier and smoke a cigar. And I was like, dude, that guy was really cool. And I don't know a thing about him. So why is that so important to you to be interested instead of interesting, which is something I tell my coaching clients all the time. And you're like the living embodiment of that, even though you've got a ton of great stories and a ton of stuff to talk about. Why is that so important to you? Like, why is that a core value and an aspiration of yours?
I just think it makes life more interesting, and it's a lot easier to be in service of others when you orient that way. But I try to show up wanting to help other people. And I find that you can do that a little bit by sharing stories about yourself. But I find that in conversation, a lot of people jump really quickly to, how they are, what the common denominator is, and how they're connected or what have you. And I just find that I find that I can deepen relationships much quicker by being a lot more curious and asking questions about the other person and kind of being more of a mirror to them. So that's where that comes from.
So it's my money, even though it's invested with you. So I'm guessing I can share whatever I want about my own account, right? Because I think I have a real life example of this. So I had a little Vanguard day trading account where I had a few $1,000 in it, and over the course of 2 years, I made some good picks, some luck, some just kind of looking at overall micro trends. Ran that up to something over $50,000, and then I was like, oh, I've got some real money now. Like, I should actually let somebody do what they know how to do. And Adam and I probably had 3 or 4 business conversations. Our personal friendship evolved into a business conversation. And you asked a ton of great questions. We had a lot of conversation in a business setting. I signed the paperwork. I transferred the money. And it wasn't until the last 4 or 5 minutes of the 3rd business call where I was like, hey, by the way, what did we invest my money in? And I really try not to be ignorant, and I really try not to make the mistakes I made in my 20s by having 100% of my 401k invested in WAMU common stock. Whoops. But it really proved a point to me that when a sales professional builds trust and builds rapport. And when they ask a lot of good questions and they're interested instead of being interesting, the client just kind of moves forward. And it's kind of like that book that you and I have talked about, who, not how, or is it who, not how, or who, not what? Who, not how. And you're my who. I don't really care how you're doing it. I just trust you to go make me some money with this little bit of money. And then if that makes money, I'll give you more money, and then we'll transfer more money. And it was the living embodiment of how this is a great ethos to live by, but it also helps in business. And I kind of saw that happening on the back burner, and I meant to bring it up tonight. So we got to it first. So am I crazy? Was that strategic? Was that accidental? Am I talking out of my behind?
No, I don't think it was either, really. I don't think it was strategic. I think that I mean, we're talking about you, so I'll just, you can edit this out if it doesn't.
No, I'm an open book. I can care less. I'll tell people how neurotic I am.
There's people that are like you, so they might resonate with this. So I would say, as I view you and what you're trying to accomplish, you're trying to grow a smallish sum of money right now to like a really large sum of money over the next 8 years, right? From 42 to 50. And so I got that right.
Yeah. Well, we've got to add money to it. We've got to get to a point where I can make $200,000 a year in passive income, and then I can retire. So my number's somewhere around a couple $1 million I've got to have in cash so that I can spin off 150 grand or something.
Yeah, something like that, give or take a few million.
Yeah, that'll be fine. What do we got to get to? 5 million? 5 million, yeah.
So my strong opinion, and I have a handful of strong opinions, is that what's a lot more important than XYZ mutual fund or ABC mutual fund or this stock or that stock is the behavior around those investments, right? So I find the most success with people that I can say, listen, don't listen to CNBC, don't read the news. Just imagine that you were Rip Van Winkle, and all you're going to do is just add logs to the fire, right? If I do my job, then you're going to feel like you are poor because I'm going to act like a vacuum sweeper, and I'm going to come in, with your permission, of course. But how much money do you have? Do you have extra? Great, let's invest that. And I've seen that work for me personally in my journey, and I've seen it work for tons and tons of clients where it really is about adding capital and adding capital and adding capital, and then letting the markets do what the markets do. So I'm very, very into the behavior around it. So it's important that you know how the money is invested. It's more important that you trust what I'm doing and lean on 21 years of experience and some really significant highs and more pronounced lows that I've experienced in my career.
Yeah. So let's talk about that for a minute. I want to get to some of the stuff that you have. You got your wisdom sheet there that you want to share with us, which I'm looking forward to. I remember when I was working at Washington Mutual, they required you to do everything. I had to get my Series 7 license, my Series 63 license, which for people that aren't in the industry, that's your license to become a stockbroker and sell health insurance. And then I had to, know how to do mortgages, because their thought was if Adam sits down with me for a mortgage, I should also be able to cross-sell him on rolling over his IRA and opening a safe deposit box and opening up a Coogan account for his kids. It's like they really had this cross-sell mentality, which was kind of cool because when the market crashed and nobody in the mortgage space knew how to read tax returns, I knew how to read tax returns because I needed to be able to, do these people's IRAs and things of that nature. So, when I started, I remember they had this marketing piece from the Washington Mutual group of mutual funds or whatever. And it was like, in no 5-year period has the market ever lost money. And then at some point in the mid 2000s, there was either a lost decade in the 90s or the 2000s where they had to change that to like, well, there's never been a 10-year period where the stock market has lost money. And just recently, I saw some advertisement from some insurance company where it was like, in no 15-year period has the stock market ever lost money. And so I'm really of two minds. As you know, I'm neurotic. We've talked about this on personal level, family level, business level, investment level, because I kind of take in so many inputs. And this is a totally unfair question because there's one Warren Buffett, right? There's one guy as smart and as positioned as Warren Buffett. So like literally 50% of my body believes Adam Stock, my buddy AJ, Mark Antonio, who does like our life insurance and stuff, it's just like time in the market, habits, put money in, don't look at it, just time in the market, it'll all take care of itself. And then the other half of my body is like, yeah, but the really good investors, there is a little bit more of timing to the market, and the whole Warren Buffett thing of rule 1, don't lose money, rule 2, watch rule number 1. And so, you know, you and I talked about this the other day, when we start seeing people like Elon Musk making excuses to sell stock and Warren Buffett taking unprecedented chips off the table for Berkshire Hathaway, and, you know, the Federal Reserve coming out with some new law that allows all their people to subtly, or all the directors at least, to sell their stock portfolios now that they've 10x their money in the last 10 years doing insider trading. I'm like, well, wait a minute. If all the smart people are getting out of the market, why am I going into the market? So can you address the people like me that are neurotic and they're of two minds, where it's like, yep, I want to be the slow and steady time in the market, just add to it every month, versus like, the people that are actually in the know seem to be timing the market or have some type of cue that I'm not looking at. So fix my neuroticism in 10 minutes.
Yeah, I mean, I hear your concern there, and I can relate to what you're describing. And I think that, well, it's important to understand what the people who are selling their stock are doing with it. So, you know, is Elon Musk selling Tesla stock and just sitting on cash? Or is Elon Musk selling Tesla stock and buying other stock? Is Warren Buffett sitting on cash? No, he's not sitting on cash. He might have sold stuff, but he's buying other stuff.
Right.
He's selling stuff that he doesn't think is fairly valued, and he's buying deep value companies because that's his hallmark, right? And incidentally, his portfolio last time I checked was over 50% Apple stock.
Yeah.
So this is not the old Berkshire Hathaway, that you used to know. He's owns a huge position in Apple stock. So anyhow, that's just providing a little bit of context to that. And I think that if people are selling to raise money for cash so that they can buy a house or pay for their kids' college, or right, well, yeah, that makes a lot of sense to sell. I have not seen successful people who get in and out and in and out, right? My neighbor's a trader. He does that fine. But like being a trader and being a long-term investor, they're totally different. And I think that that's one of the things that confuses investors, because as financial planners, we want our clients focused on their financial plan. We want them focused on the long term. But every day you can turn on CNBC and Squawk Box and any of those things. And what's their job? What's the role of CNBC, and what's the role of Maria Bartiromo?
To sell ads.
Yeah, that's it. To get viewers. So how are you going to get viewers if you're Kramer, right? How are you going to get viewers? Are you going to say, you know what? The market was flat today.
Yeah.
What are you going to do the next day? Oh, it's kind of boring. No, you're not going to say that. You're going to use extreme language.
Yeah.
The stock soared. Stocks crashed.
Yeah.
Right. All of this extreme language, it just creates a lot of noise and a lot of anxiety that's really unnecessary. So I encourage clients to think about the visual of a child doing a yo-yo, walking up a hill, right? So if you look at the yo-yo, that's the day-to-day, and you're going to see your stock portfolio go up and down and up and down. And that's why I tell people not to look at it every day, because unless you're planning to sell it, why bother looking at it every day? Right. The long term is the mountain. So I think what's most important is that you have your time frame right, you have your philosophy right, and then you just add and add and add and add. Create the gap between how much you earn and how much you spend, and then create that gap bigger and bigger and invest that difference. And I'm not saying that it doesn't matter where you invest the money. I mean, certainly there are higher return investments and lower return investments. And so like that does matter. But what matters more almost all the time, not all the time, but almost all the time, what matters more is the capital that you're putting in to your investment portfolio.
Yeah, it would be really hard for Kramer or Squawk Box or any of those guys to sell ad space if every day for an hour they just said, keep your expenses low, pay off your debt, try to invest 10% passively every month. I mean, if they just said that over and over again for an hour every day for 10 years, there would be no show. So, I totally get that.
And that's part of our job as financial planners, is to be that record that's playing over and over, that's saying the same things, and just maybe packaging it slightly different or using a different analogy. But the tenets of building wealth don't ever change.
Yeah. So let me ask you another question along the financial planning side. And it's funny, we had this conversation a while back with somebody else, and I'd love to get your take. Again, kind of being of two minds, which is my theme. I think it's good in some ways that I believe two things can be true at the same time, but it also kind of messes with my brain when there's questions. So this idea of being of two minds, with inflation being a real thing, things are getting more expensive. I've heard from a lot of people I trust, and again, it's kind of evenly split down the middle, where they're like, hey, inflation is really going to take its toll on the overall economy. You can pick any asset, crypto. I've got a block of silver in my safe, or I've got a house that I own, or I've got an antique car. These are not things that I own, but I'm just saying, if people have these assets that have inflated in value, like half the people I hear from are like, ooh, sell the assets, have some cash, have some dry powder, because inflation's going to end up having, bad effects on the market, and this inflation is not as transitory as we think it is going to be, and you want to have some cash for dry powder to invest in Atom or buy platinum Rolexes when they're on sale or whatever, because that's going to happen in the near future. And then like the other half of people are like, screw it, I'm leveraging myself to the hilt. I'm buying another property. I'm buying more, pick an asset, bar of silver, crypto, art, classic cars, because the inflation in the market and what we're doing with kind of printing money in the United States is just going to continue to make prices rise for the foreseeable future. So I guess that's a very long-winded way to say, can you explain to people, maybe the novice that's watching this, what inflation is, why it matters or maybe doesn't matter, and then do you have any opinion on what people should do about it?
Sure. So what is inflation? Inflation is too much money chasing too few goods. That's like the econ 101. So when you have a lot of money in the money supply.
And we lost your mic a little bit. I don't know if you leaned in the computer or something, but we lost your mic a bit.
Maybe. Sorry about that.
That's much better, so, yeah.
Inflation is too much money chasing too few goods. That's the economics 101 definition of inflation. And it's not necessarily a bad thing, but it's a bad thing, for example, if you're holding fixed income assets.
And what does that mean? Explain to the novice what fixed income assets are.
Yeah, a fixed income asset is like a CD or a bond that has a stated yield. So right now, yields on bonds are really very, very low, historically low. And usually that you can think about the yields on bonds as somewhat correlated to interest rates on mortgages. So like if you're able to get a really low mortgage at the bank through a bank or a lender, you're also likely to not be making much money on your checking and savings accounts.
Right.
So there's a correlation there. So there are assets that are better hedges against inflation than other assets. And some of those assets, if you want to stay in the fixed income, like if you're just afraid of the stock market, you can get investments that have some inflation protection. They're called TIPS or MIPS. Basically, they're fixed income investments that have like an inflation kicker, let's call it. So, but I mean, historically, the best hedge against inflation is owning stocks, owning companies. So I think it's fine to have like different, hey, a part of me feels this way, a part of me feels this way. What's most important is that when the stock market goes down, that the part of you that felt like, oh, I know the stock market's going down, doesn't all of a sudden say, "See, I told you shouldn't have had the money in the market," because that's what people do, and then they bail out. And I mean, there's really strong research to support that 5 years ago the U.S. stock market was overvalued.
Right. Right.
Very strong research to support that. And if you had said, "Oh my gosh, it's overvalued," what you would realize is that really clearly is that there's two things that drive stock prices: the underlying fundamentals and the speculative effect. So the speculative effect is how much people think a company is worth, whether it's worth that today or not, right? Like when you look at a company like Tesla that has $1 trillion market cap and is $1,200 after it's split 5 times. I mean, it's you look at the market capitalization, which is the number of outstanding shares of stock times the stock price, and that's supposed to represent the size of the company. But then you have a company like Rivian, for example, that does an IPO, and with having produced 20 cars,
Right.
they suddenly are a bigger company than Volkswagen. Or I'm giving some examples.
Right.
Ford, like that have billions of dollars of revenue. So how you make sense of that is recognizing that in the long term, when you buy a stock or when you buy the stock market, when you buy a broad index, you're buying future earnings. And it might not be that those earnings are going to come next year or 5 years. Like, was it intelligent to buy Amazon stock 20 years ago? I mean, then you might have said, "Well, geez, they didn't have any profit."
Yeah.
That,
Didn't
right?
Amazon lose money for like their first 11 years of existence? I mean,
Yeah,
theoretically, the company is worth negative dollars in current valuation, but people were driving up the stock price, seeing the future value, and
correct.
somehow Jeff Bezos threaded that needle where he went from like, oh yeah, Scott wants to buy a book for $19.99 and doesn't want to drive to the store, to now Amazon is completely intertwined in every fiber of our being, our family,
Right,
our everything. So I mean,
right.
they're the rare company that threaded the needle of like showing up to that future value stage, and they did it, and it's amazing. But I'm guessing, back to your Tesla example, if we're defining the market cap by all the outstanding shares of the company times the value of the share, and that means Tesla's worth $1 trillion. There's no company out there who would pay $1 trillion for Tesla, because Tesla's not making anywhere near that much revenue or profit, right? Am I reading
Correct.
the tea leaves
Correct.
correctly here?
No, that's correct. That's correct. It's just, people think, "Oh, well, Elon Musk is a genius and Tesla's going to be the next Amazon." Whatever company is going to be the next fill in the blank.
Right.
And so they want to be in early, and they're willing to invest in the company, even though that company might not have profits. And what's really interesting and kind of a paradox is that once a company has profit, it's a lot more easy to value the company.
Right.
So now you really know, oh, the company has profit. Now I can value it more clearly. And now I can see, oh, it's worth, it's 100 times earnings. It's 200 times. No way, I'm not going to. But when it doesn't have any, the PE ratio is the price of the stock divided by the earnings. And when there isn't any positive profit, when there isn't any earnings, you don't really have a PE ratio. So it's nebulous, and that often leads to people speculating, sometimes really well, but sometimes huge losses
Right.
as well.
Right.
And so those are, kind of like when people go to Vegas, and I don't like to use Vegas examples because investing in the market is very rarely like gambling, but it is when you pick an individual stock that doesn't have any, that doesn't have any earnings, that doesn't really have any infrastructure. All you're doing is you're betting that they're going to at some point in the future, whenever that is.
Right.
So because there are the two pieces that drive up the markets, the underlying fundamentals and the speculation, that's why people, you can't outsmart, so to speak, the market. And really smart people, oh well, I saw that housing starts are up, oh I saw that unemployment's down, I saw that the speculative effect of the market is real. And so over time, yes, those things matter. But in the short run, they may or they may not matter.
Do you want to know how crazy I am? And I hope my wife doesn't watch this podcast. I simultaneously think Rivian's going to be a giant flop, and I put $1,000 deposit down on one of their trucks because I think it's so cool looking. It's like I want one of those trucks, and I think this idea of a car company that can change the world, and we're gonna somehow make everybody super eco-friendly. I believe that the founders of Rivian have a really good idea. They got some really cool designers, and they've basically conned a bunch of California rich liberal hippies into thinking that the car you drive can change all of your opinions on the environment, global warming, how I treat, plastic. And I'm like, I don't think we have an example. And if they do it, God bless them. That's awesome. I hope the environment is better off when my kids are my age than it is, at where we are currently. I hope it's true. And I think it's going to be a giant flop because your standard, I mean, I think the F-150 is still the top selling car in the country. Your standard, middle America F-150 driver that drives it for work and for sustenance does not care about feeling good about his truck saving the environment. And so you talk about a $45,000 F-150 versus a $100,000 electric car, and you should buy this electric car because we're changing the world. I don't think most truck drivers and SUV drivers give a shit. I think Elon kind of threaded that needle of like finding a rich segment of people that wanted a super fast sports car, and they were willing to spend 120 grand thinking that they were changing the environment. But I think your average soccer mom and your, Joe Plumber who needs a pickup truck for work, I don't think they're going to buy into this Rivian message. So I think they're going to be a giant flop, and I want one of their trucks.
Yeah, and I think that's, I hope that you enjoy the truck.
Yeah, exactly. Hopefully I'll be able to find somebody to service it if they go out of business.
Circling back on your what do you do when you feel a certain way? I think that about inflation or about the market or about anything, I think that's part of the reason that it's really good to be diversified, because not all asset classes move in the same way, and different assets have different sensitivity to interest rates, to inflation, and we don't know exactly what's going to happen with inflation. I think that we have a tendency to want to simplify, and so there's a lot of people out there that say, "Oh my gosh, we just printed tons and tons of money. Of course there's going to be hyperinflation. That's what happens when you print tons and tons of money, right? When you give money, when you give trillions of dollars of PPP money to business owners to save their, of course that's going to come into the economy, and it makes logical sense, but then it's so much more complicated than that. And so it's easy sometimes to buy into simple stories without realizing that it's a lot more complicated than that. And I mean, in 2008, tons and tons of money was printed. We didn't have inflation. And as it relates to PPP money, for example, and all the money that was printed recently by the government, if people, give their money to me to invest, that's not putting it back into circulation in the economy. So you don't have inflation when people take the excess cash and invest it in the stock market.
Yeah.
So those are just two examples that even though it's true that a lot of money has been printed, that fact doesn't necessarily mean that de facto we're going to have hyperinflation.
Right. One of the things I was actually encouraged by, one of the silver linings of, the pandemic, which I think there was actually several of them, is I read something a couple months ago that the U.S. savings rate is going in the correct direction for the first time in a long time. Now, that could unfortunately be because people aren't eating at their local restaurant, or they aren't making their car payments, and there's other downstream
Or they're
negative,
not traveling,
or they're not
right?
traveling. Yeah, and there's other downstream negative effects in the economy. But it's actually kind of nice to think about Americans maybe taking a step back from this endless splurge of consumerism, and saving a little for a rainy day, and realizing that, like, whether it's a sickness, an illness, a government, whatever, like, you can have some challenges that are a little outside your control. Maybe we should have some more savings. So I can see your skin crawling that you're very opinionated about this. So go for it.
No, it's interesting. Like what just came out of your mouth is something that would normally more come out of my mouth than your mouth. I just don't buy that. I mean, I think that there's just a lot of pent up demand, and I mean, I just saw it with myself, right? Like I was like, we didn't take a large vacation last year because it was COVID. I'm going to spend more money fixing up our house, right? I mean, there's the contractors that do brick paving and building additions, and I mean, their pipelines are extraordinary. I mean, you can't get somebody to do work for months and months.
Yeah.
And I mean, that's great for them, but I just think that you're seeing a very temporary and artificial savings rate, that as soon as people can go on cruises, travel freely, that's going to go right back to where it was before.
So this kind of goes back to your why you should have more time in the market, right? Because if a year from now your thesis is correct and there's a huge influx of cash into AMC movie theaters and Carnival cruises and people buying Teslas and whatnot, the quarterly earnings for the stock market are going to reflect that. And people are going to have to
Yep.
price into, like, oh shit, all this money's coming out of the woodwork and going into companies, which therefore makes their
Yep.
stock more profitable. So that's kind of the best thesis I've heard thus far for why continued investment in the stock market and not getting queasy about it makes a lot of sense. So look at this. We're having a breakthrough, Adam. So
Just give me some time.
give you some time. Yeah. So, all right, tell me, you got your list of wisdom there. And on the Edge podcast, although we've gotten away from this a lot, the goal was kind of to either have edgy conversations or have conversations about things that could give people an edge. And right or wrong, we've skewed way more to the edgy conversations versus giving people an edge, because there's endless stuff I can complain about in politics, and maybe we'll get into that in the tail end of the show. But give us some of your wisdom as far as your life experience is pretty vast. You've accomplished a lot. You're currently in the throes of raising 5 kids. I think they're ages like 6 to 14 or something like that.
Pretty close, yeah. 15, 12, almost 15, almost 12, almost 9, almost 6, and almost 3.
Oh my God.
So 3 years apart, almost to the month.
Dude, that
every
means
one of them.
That means you've almost had kids in diapers for 15 years straight.
Yeah, we definitely have.
Oh my goodness. All right. So a lot of life knowledge there. Give us a couple things on your wisdom list. And I will tell people the first thing that I learned from you off of your wisdom list is really owning your calendar. I think that was the first business kind of introduction we had, was for the Front Row Dads group. You did this whole thing on kind of planning your year, planning your calendar, not having any quarrels with your wife if you guys are aligned on the calendar, making time for our kids if you're aligned on the calendar. So I know that's one big place of wisdom where you could talk for the next 2 hours, but give us some of the fun stuff on your list there that you jotted down for our audience.
Yeah, and I would just to kind of bridge between our last conversation and this conversation, I would say one of the pieces of wisdom is, you might be a really, really highly intelligent individual. I mean, I have a fairly high IQ. I went to an elite college. I went to the London School of Economics. I have my master's degree. I have my CFP. I have a lot of credentials. And when I go to invest money, I just do a lobotomy. I really do believe that stripping away that intelligence when you're investing, as long as you're investing in smart stuff, like, don't outsmart yourself. And you can't outsmart the market, right? And last year, and I will get to this list in a minute, last year was the perfect example of how you can't outsmart the market. When COVID hit in March, and the market took a really deep dive, there were tons and tons of reasons to believe that it was either going to go lower or go a lot lower, right? Oh, well, the cases are just going to get worse. Um, the summer is coming, and you heard what, COVID spreads more in the summer. There's going to be a double bump. We're not going to feel the ripple effects of this until the fall, till the winter. I mean, I heard every great reason why the stock market should not go back up. And it did like a V and then more than that. And so that's just the perfect example of how you could very easily rationalize and justify why things were going to crash, why they were going to get worse. And, you know, unfortunately, some people, not my clients, but some people did cash out at the bottom. And they
And
waited and waited. And by the time that they got back in, man, they had lost tons of money.
and what did they lose on the upside? So let's say a client started with $100. Doesn't matter what his original cost base it was, but at a moment in time, February of last year, he had $100, and he pulled out when he had lost what? And what did he miss to the upside?
Yeah, I mean the market went down 30 some percent in 6 weeks. And then it went from um not quite double, but I would say from let's see, the bottom of the market in 20 March 2020 to where we are now. It's yeah, 100%.
Yeah. So if you had $100, you spooked and sold at 70, that went back to $150. So you lost out on $70-$80 per hundred that you bailed at the wrong time by trying to outsmart the market.
I mean, yeah, $200, yeah.
Wow.
$100 at the bottom would be worth double plus, more than double now.
Amazing. All right. Well, there you go. So tie into the wisdom, unless of course you want to talk about Jordan, because every time I talk to you and I see the Wheaties boxes and the Air Jordans behind you and your shrine to Chicago basketball, feel free to work that into any of your life wisdom, because I'm a big fan of using sports analogies when it comes to giving people coaching lessons.
Yeah, I'm gonna have to give that some thought.
All right.
Yeah, I grew up in Chicago in the 80s and 90s when the Bulls were just an extraordinary team. And I got a chance to watch Michael Jordan in person, go to games. This is my first pair of Air Jordans that I wore in 1985. So I was 12 years old, and these are actually my shoes that I still have. And I started collecting Wheaties boxes. They're full Wheaties boxes. I just kept them in my closet, and then here they are. So but just it brings me back to an era that is just a lot simpler, I think, in many respects to now. And also, when it comes to people comparing other athletes to Michael Jordan or other basketball players today, and no disrespect to the basketball players of today, LeBron James is absolutely an extraordinary athlete, and his longevity in basketball is extraordinary. But what Michael Jordan did to elevate the entire game from where it was, you had Magic Johnson and Larry Bird who elevated it, and then Michael Jordan, I believe, took it just to an altogether different level. And if you watch some of the footage of him playing and the tenacity that he played with, it's really unmatched in my opinion. So um, I don't think that relates to a whole lot else that we're going to talk about, but it was a cool time to grow up in Chicago.
That's pretty spoiled of you.
Yeah, yeah, I'll take that. It's okay.
Perfect.
Um,